Hi, welcome to the first in a series of videos on consolidation. Today we're going to be exploring the entity concept. Here I have three fictional businesses. They're all companies in their own right. They do their own tax returns. They've got their own ABN or ACN or CIC or whatever it is, depending on which country you are in. Swan Copper makes, amongst other things, copper pipes and popped copper fittings, which of course is used in the hardware industry, in particular in the plumbing industry. Swan Plastics make downpipes and all those other bits and pieces that they then sell through to Swanlink Plumbing Supplies. They also sell it to other companies like Dickies, Mitre 20, BBC Hardware and Hughes. Up until this point, there's just a number of companies that are trading with each other and selling normally, buying and selling to a company, making a profit as they go along. The difference here is, however, that the Swan Group is another company that actually owns 100% of all the shares of Swanlink Plumbing Supplies, Swan Plastics and Swan Copper. So when it comes to consolidation, we need to treat these four companies, Swan Group, Swanlink Plumbing Supplies, Swan Plastic and Swan Copper, as if they were one company. So we are treating them as if they are one economic entity. The funds that Swan Plastic and Swan Copper have earned by selling to Dickies and Mitre 20 and BBC Hardware and Hughes, we don't have to worry anything about. However, those sales that have gone from Swan Copper and Swan Plastic to Swan Plumbing Supplies have been made with a profit. They've built a plastic downpipe at $4, they've sold it to Swanlink for $5. We need to pull that out because we can't recognise a profit that we've made within our own group. When we're talking about the consolidated entity, we're talking as if it was basically one company. So Swan Copper, Swan Plastic and Swan Plumbing Supplies are no different to just divisions of a normal company. And in there we wouldn't normally recognise a profit when we transfer inventory from one department to another. So from the economic entity we can't do that either. We need to make sure that the only sales that are recorded are those sales with outside entities or outside of our economic entity. So the sale Swan Copper to Swan Plumbing Supplies, we need to make sure that is just a transfer of inventory. There's no profit made. If that inventory is then on-sold by Swanlink to an entity outside, a retail situation where we sell it to a customer, then we can recognise that profit. So there's a number of things we need to do here. In a real-world situation, you would hope that the chart of accounts that is set up with all these different companies is such so that it would capture a sale differently if it's made to a related group or an outside of the economic entity group. Usually something along the lines of an intercompany sale or intergroup sale, which is recorded separately to the normal sales. Now, it only may be one or two numbers from the normal sales account, but you've got our normal sales, we've got our intercompany sales or intergroup sales. So it makes it much easier in the real world to make those adjustments going forward. Thank you for listening to this. We'll have some more videos up shortly. We'll talk about transactions that need to be eliminated, the reasons why and how we go about doing those eliminations.